good morning, or afternoon or evening if you're listening. It is Jackie P and Julian D. Leonardo, Inevitable Wealth Pod, episode
15.
15.
15.
Yes, because 13 was a two-parter, so this is 15. Julian, how are you today?
Good. Good morning. How are you?
I'm doing great. I cannot complain. So today we were thinking about walking down memory lane. Sometimes a lot of folks forget about the major declines of the market and sell-offs. So February 2025 is when we're recording this. It's 5 years after the COVID pandemic and shortly lived actually market meltdown. So we thought it'd be a good idea to talk about some of the metrics and what went on then, and perhaps what we're seeing today from the results of that. So Julian, where do you say we should start?
Well, we can talk about sort of what things looked like pre-COVID and how the market was looking before that drawdown. So when we look at it, what was your view of the market at that point? So 2018, 2019 into 2020, what were we looking at as far as market impact?
The market was hitting all-time highs, if I remember correctly. It was like a decade-long bull run, right? From the great financial crisis of 08, 09, which I feel people remember stronger than the COVID sell-off. I think everything was just humming, right? Unemployment numbers are low, GDP was growing, corporate earnings were just driving growth across the board. But I think there were a few people, I'd say, I wouldn't say waving a red flag, but waving like a cautious, hey guys, like let's be slow with this.
Exactly, and that's pretty common. I don't think they necessarily expected a global pandemic to be the thing that really turned the tide. But yes, markets were healthy. If you recall, 2018, there was a 20% drawdown roughly in November, December. And then right after that, you saw a big uptick where global markets up about 24% in 2019. So great year preceding that. A lot of optimism, everyone feeling great. And then come January, if you recall, you start to hear, hey, and we had this before with the Ebola outbreak and different types of things going on, where it was like the coronavirus, the bats, right? And it was like whispers. And the expectation was it would go similar to Ebola, where there's a brief correction. I think that was far more muted.
Yep.
And then after that, seeing it, things proceed as normal. I don't remember the exact day it happened where we started to see that, but it was late February, early March. You really start to see a downturn. So what did that look like, and how's that compare to things today if you were kind of evaluating?
So the number, I don't remember what I know. I remember it bottomed out around March, mid to late March. And the S&P lost over 30% in a few weeks. And I remember seeing in my day, and I don't think I was a grizzled veteran at the time, but like just the wildest swings, intraday swings, right? Where I think prior to that, and even now, I think we've sort of forgot, the market was swinging 6%, 8%, 10% here or there. NASDAQ did 12% one day.
Real volatility. Now,
that is
when things are good, the market draws down 1.5%. Yeah. You turn on CNBC and it's like Dow Jones down.
Yeah.
And it's not 12% like it was at that point, because you saw the market peak mid-February, and then within a couple of weeks, probably 2-3 weeks, it was down 34% in mid-March. So that's a significant drop, especially with those intraday swings. Because we were sitting next to each other even then. Essentially, FactSet it's called, where it's up all the stocks each day, and it was just all red.
All red.
And it was Exciting, not exciting. It was energizing in the sense that there's a lot of great positive moves you can make when things are like that.
Hmm.
But certainly very quick in how it
Yeah,
happened. It's like
yeah,
you woke up and it was just
yeah,
you were suddenly in one of
yeah,
those tanning booths, all the red light.
yeah, yeah,
Um, Seinfeld episode
yeah.
where they also. Um, what would you add to that?
I would say one thing too was the historic, just the VIX, VIX. If you're listening, not aware of what that is, it's essentially a fear index. I'm just gonna boil it down and oversimplify it, but basically, when volatility is expected, the VIX goes higher. So, I remember seeing that as record highs as investors panicked. I think people were panicking as well, like just not even stock related, but it was a pandemic, shut down, all these very new things that folks have never really dealt with, especially here in the States. Yeah, there was fear everywhere, I think, which was, I still kind of remember having to talk to clients and walk through and saying, hey, like, uncertainty is usually the cause of most volatility. And this is perhaps the most uncertain things
Exactly.
have been.
I mean, American Airlines stock went from 28 to 10 within 2 weeks.
Wow.
So if you had $1 million in there, you now have 300,000.
Yeah.
And it hasn't recovered since.
Absolutely scary.
That's why, conservation risk.
Yeah.
And then the last thing I would add is if you recall, oil went negative where they were paying you to take oil because things grounded to a halt and they had nowhere to put it. So if you bought an oil contract, a futures contract, they were essentially paying you to take it at one point in that March timeline, which was very unique.
Yeah.
And if you had the foresight to see how much money was going to be pumped in the economy and the rapid recovery, you certainly could have made a lot of money.
Yeah, no, absolutely. And I would say too, and we did a lot of rebalancing those short, I'd say 3 months from February to May-ish when it was so volatile. And I think I don't know what feedback you've got, but I know we got a lot of scared feedback at first saying, hey, why are we buying? We don't know what's going to happen. No one's leaving their houses. But that rebalancing showed to, be effective, right? Because we knew long term that we don't know how long it'll take, but things will come back up. And there was a lot of opportunity as well.
Exactly. And it was the fastest drawdown from peak, right? Fastest peak to 10% drawdown in history. And it is interesting when you're serving families and businesses, usually the first 10% component of the drawdown has a little bit more anxiety where it's like, oh, should we be buying now? But we run a rules-based process. So yes, we're going to buy when we see opportunity. And then once you get from like 15 to 20%, everybody settles out. And they say, all right, this is a good buying opportunity. And then once we hit, down, it's down 34%. It's kind of like, well, what's the worst that's going to happen? Because it already has happened, to an extent. So you do see that where when markets are within a certain range, there's almost more anxiety. And once you go beyond that first standard deviation, folks tend to just be more comfortable.
It definitely levels out.
And that worked well. So that.
And I think one thing too, and we can move on a little bit about the response from the Fed, but a lot of folks tend to also forget that we've been through this, not this specific thing, but like a market meltdown before. A lot of our families that are approaching retirement, their retirement, right? They lived through 07, 08, they lived through 2001. They probably remember 87, right? So I always find it interesting, I think, how give it a year and a half afterward, folks will see a 1% move in the market and be like, holy moly, what's going on, right? And we talk about a lot of it's the news cycle, but we've seen some real tough days.
Absolutely. And the Dow Jones is now at 45,000.
Right?
So when it used to be at in 2000, it was at 10,000.
Yeah.
So a 500-point drop is very different now. But because they do that on the news where they anchor by points instead of percentage, it certainly creates a little more hysteria. But at the end of the day, the 2% drop is nothing. And we're very proactive when there's any moves in the market and reaching out to families we serve. But when that happens, it doesn't necessarily need to be.
So let's talk about, a lot of folks would say, basically, as you mentioned, pumping money into the economy, right? So the government and Federal Reserve had some good responses, I think, that really helped, I'd say, pull out of like the depth of when the market was slumping. So walk us through, Julian, a few of the moves that happened in that time frame.
So it's the money in the window approach. It's the same as 2008, right? Where the Fed came in and they don't need to just put enough money to stimulate the economy. They need to put more, right? To increase confidence and make everyone feel, have high conviction and things going. So you did see a lot of work from home companies like Zoom obviously took off. Amazon took off, right? Everybody was ordering things online. Netflix soared.
Peloton hit the moon. Came right back.
And certainly a lot of mania around those names. But if they didn't have the fundamentals, they rapidly
came right back
to earth. And some have not. Many. And then you saw the meme stock mania, right? So everyone is work from home. You start to see GameStop, AMC, all of those, especially with the increase in retail trading on stocks on apps like Robinhood. And then a lot of retail struggle, right? Because everybody was from home. And they still had these rent payments to make, and nobody was going out to buy anything. What would you add?
I would definitely add to the interest rates going to zero, I think was historic, because I remember my mom talking about her first mortgage was like a 16% interest rate, and people were, I think people were refinancing left and right because they're getting sub 2%, sub 3% interest rates. So now, just to think about it, especially as interest rates have recovered, it's almost like an antique. We spoke with someone who had like a 1.75 interest rate on their mortgage. We're like, don't ever get rid of that. Don't leave. You can't. That house is yours forever. So I think that also just the consumer, like we were spending money, which really was a good.
I don't think that's stopped either.
It hasn't. No.
That's continued. But certainly there's a lot of jokes online about how did I not buy a house in 2020? With interest rates around 3% for the average person, and now they're about 6.25%, depending on how recently checked. And what sort of structure. That's certainly a difference of a couple $1,000 each month.
It's a big difference. And I think the trends before COVID and after have been significantly different. I think the biggest thing most folks are aware of is the inflation, right? Inflation has been the number one topic from economic perspective since 2020. And it still is. It's still.
I'm laughing. My wife Angela has texted me pretty much every day, because everyone in her new office, keeps talking about the price of eggs. And she's like, "How are we talking about eggs again? Why are we on this?" But they do increase. I think when you look at inflation, a lot of it is these second order effects from COVID. And how quickly that's forgotten, and we blame the president in office or the prior president. And at the end of the day, we had a global pandemic that shook up the world in a way we haven't seen in a century. And the inflation is uncomfortable, but what would have been more uncomfortable is not recovering. So what we're doing with inflation is burning off the spending to an extent that we had prior. And when you look at second order effects, you can go back even further to 2008. Say, why do we have so much stimulus? Because we did it before, right? So it would be a third order effect from 2008.
Yeah.
And all these dynamics.
Yeah. And it's also interesting to think about how there's still disruptions in the supply chain.
Mm-hmm.
And, I forget, I think it's in that book. I was wrote the book, Same as Ever.
Mm-hmm.
When he says, you don't really see like what's wrong with your system until you're in time of crisis. Mm-hmm. And COVID was like perhaps the, knock on wood, the crisis of our lives so far. So we're still feeling 5 years later the shortfalls of all of the systems, the kinks in the systems that perhaps would not have been addressed if we didn't have that.
Yeah, and you saw it with the ports, right? Yeah. Where because we didn't automate ports, we had this bottleneck, right? Where they weren't getting ships to offload because they were on strike, and then you go back to 2020 during this as well, and the same thing where because of COVID, not necessarily strike, couldn't get things from one place to another.
Yeah.
So history, where they say history doesn't repeat, but it rhymes.
It rhymes, yep.
So different causes, same outcome. We saw a lot of issues because things aren't as efficient.
Yeah. And one thing as well we should talk about is just the lessons learned, right? Like the first is just, even though COVID was a very long experience, and just like everything economic, just personal, everything, but the sell-off, the market bottomed out extremely early. And I think a lot of folks don't realize that, especially in the last years of past, when they're saying, oh, there's going to be a recession or everything. Folks don't typically realize, more often than not, we're already on our way out of the recession when the world realizes we're in a recession.
Exactly.
So I think that was another lesson that should be learned and remembered, like how quickly markets can crash, sell off, and start climbing back up.
Exactly. For the most part, in other corrections, a lot of times when I'm speaking to my parents, my dad would come to me with a hot tip or something. Yeah. Say, by the time you've heard about it, it's too late.
Yeah, yes.
Often that way with most drawdowns or recessions, where by the time he's heard about it, I know it's pretty much over.
Yeah.
But in this case, I think if you took a long nap, you missed the whole thing. So the peak was in mid-February, and then the market returned back to that peak in roughly August, maybe early September.
Yeah.
So it was very rapid. And that's why when you think about market history, 08 resonates so much more with folks because it was a slow bleed. And it's usually the most painful. A lot of unknowns at that time as to what was causing it and what the general health of different banks were, like Lehman, Bear Stearns, Wachovia. Wachovia, very much forgot.
Yeah, Wachovia. I used to have Wachovia.
Yes, no one talks about Wachovia. So it was a lot more slow bleed and a lot more unknowns, whereas this one was rapid, and you essentially just took a punch off the bat. You knew what it was. You knew what the impact could be. And it was very, very.
Yeah. And what are some trends that we've seen from COVID? Like, for instance, like work from home, like I think just the whole work-life balance, all that energy has been.
It's changed. I'm not sure if you saw the Jamie Dimon.
I did, and I heard his little hot take.
I think he linked it on purpose.
Yeah.
But if you don't know, I would recommend looking it up. And he spoke with a pretty high level of conviction about how work from home leaves younger members of the workforce behind because they don't have the relationships, the skills, and the experience, of course, that the older folks have who have been working and been in industries. So he wants everyone back to the office now. So that's something that has changed but may revert. When the music's playing, nobody really thinks about it. And then once things get tight and budgets get tight, the guy you never see in the office and has no relationship with who's making the call will probably be the first out. So you do see that somewhat coming back around now, regardless of budgets, regardless of everything. And then interest rates, of course, continuing to climb to combat inflation. Where do you think things will go next?
I think, well, one, we didn't talk about AI. AI is definitely all over the place. I think AI is throwing into conversation and things that shouldn't need to. I got a new phone and my text messaging has AI. I'm like, I've got this handled.
I turned that
Thanks.
off.
Yeah, I turned it off too.
I already read my text, but
Yeah. I turned it off too. But yeah, I think there's just going to be one, we have just a big shift of the generations, the younger generation, Gen Z. I think it's Gen Beta after Gen Z that's coming to the workforce. So I think I don't disagree with Jamie Dimon. I do agree. We have a very flex thing, but there's a more of a hum when everyone's in the office and we're learning off of each other. But I also have a kid and I like to be at his things, and the flexibility is important. But yeah, I really don't know what's going to happen. I think the Fed they released their scatter plots. They never really stick to it. So we don't know what to do there.
Wildly.
Yeah.
If you're out there, you know what the scatter plot is.
Yeah.
And they say the Fed expects 2 rate hikes next year. Their miss rate is like 90%.
Yeah.
They're basically playing baseball. They're not a Hall of Famer. They're hitting 200, 190.
Yeah.
Don't read too much into it.
Yeah. But we'll see. I do hope that there's a couple cuts this year. I hope, if it made sense. But I am hoping that for the most part that folks just remember and also not look at the numbers too hard. So thinking about inflation, everyone was panicking with the last numbers and it was off by like 10 basis points. So, it's okay for it to not be where it's expected, especially at 10 basis points. That's marginal.
Do some, I encourage folks to do some second level thinking, where if the title of the article says inflation hotter than expected, click the link and see that hotter than expected means it's at 3% instead of 2.9%. So while that's not insignificant, the title would lead you to believe that it's World War III. So something to think about is taking that next level. What I've enjoyed year to date is that international is outperforming the S&P 500. So always a good reason to be diversified is you don't want to take any unnecessary risk where if one component of your portfolio outperforms, your plan is dead in the water. So you do want to hold international and US. And this year so far, international is up about 7.5. US is up about 4.5. So it's a pretty good delta. Doesn't mean it's going to stick forever, but if you were to rebalance today and trim that international and buy some US, you'd certainly have some positive long term.
Yep.
There's a lot of different nuances in the market, but the plan you put together should drive your investments more than Jerome Powell's scatter plot. Or inflation numbers from the Wall Street Journal that are overstated. Or your neighbor.
Definitely.
Is watching and reading the same CNBC that most folks are seeing. He is not Kendrick.
And one thing I would say as well is, we shouldn't be making any long-term changes on short-term events. And I'm proud to say that none of the families we served went to cash or sold during the sell-off or any sell-off in times of past, and we've bought. So remember, if you're a long-term investor, these are short-term events. The market in time will recover, right? And you shouldn't have any money in the market that you need within the next year or two anyhow. So if you have a strong financial plan in a long-term view, turn off the noise. That's what we say, right? Block the noise out, turn off the TV.
I was about to get warm out. Go to the beach.
Go to the beach. Go to the mountains.
Go do something.
Play pickleball. That's what's hot right now.
So pass, run to the next thing. Before panic, storm will pass, run to the next thing. So it will continue for all of eternity.
So
well, thanks everybody for joining us. It's been great.
It's been great. And remember history. History has a lot of lessons in it. So
sun's about to set after 7 p.m. in a couple weeks, that's all. So
we're so close. All right. Everybody, thanks for listening.